Stock markets are near historic highs, while global macroeconomic risks continue to rise. So the question is pretty simple. Is the market ignoring reality, or are we looking at the wrong data? Because when markets rise while global macroeconomic risks increase, something's usually about to break. If you've been following the markets recently, you probably noticed something pretty strange. I'm going to explain it more clearly by the end of the video. And if you don't know me yet, my name is Chad. I'm a presenter at Zero Markets, and on this channel, we bring content in every video designed to help investors and traders become more critical and more aware of the market. While indexes like S&P 500 and NASDAQ remain strong, the global macroeconomic environment looks increasingly fragile. Higher interest rates for longer, geopolitical tensions, slowing global growth, and record public debt. In other words, global macroeconomic risks haven't decreased, they've increased. So why does the market keep rising? Today, we're going to analyze why this disconnect happens, historical examples where this has occurred before, what professional traders watch during these moments, and how you can position yourself strategically when the market ignores global macroeconomic risks. One of the biggest traps in the market is believing that price always reflects economic reality. But in practice, price often reflects only liquidity and narrative. A recent example, even with US interest rates at their highest level in more than 20 years, the market kept moving even higher. According to data from the Federal Reserve and the IMF, the global cost of debt has reached historically high levels. And even so, investors continue to buy risk. Why? Because there are three forces that often mask global macroeconomic risks. The first force is liquidity. Even with high interest rates, the global financial system is still full of capital. According to data from the Bank for International Settlements, or the BIS, the global liquidity remains elevated due to stimulus programs still active in some countries, corporate credit expansion to institutional capital searching for returns. When there is enough liquidity, markets can rise even with obvious risks. That's exactly what happened between 2006 and 2007 before the financial crisis. Another important point is that the market can appear strong even when most stocks are not rising. Today, there is massive concentration in just a few companies. Bringing more data so you can understand the impact more clearly. According to Bloomberg and Goldman Sachs, the so-called Magnificent Seven have represented more than 30% of the S&P 500. This means a few companies are driving the index, while a large portion of the market remains pretty stagnant. In other words, the index goes up, but that doesn't mean the global economy is healthy. Before we conclude the video, if you made it this far, comment global market so we can see who you are and how our content has been helpful for those watching. Continuing, the market also runs on narratives. Today, the dominant narrative is artificial intelligence, AI, technological innovation, future productivity. None of this is necessarily wrong, but strong narratives often make investors ignore global macroeconomic risks in the short term. That's exactly what happened. During the internet bubble in 1999, before the 2008 crisis, and even before the drop in 2022, when there is a disconnect between price and macro reality, institutional traders start watching some very specific signal. If credit spread starts to rise, it indicates financial stress. In addition, the yield curve, historically, yield curve inversions precede recessions. And finally, institutional flows. Global macro funds usually reduce risk before the market realizes it. These indicators often reveal global macroeconomic risks long before the stock market reacts. So what's the biggest lesson here? Market can rise for much longer than seems rational, but ignoring global macroeconomic risks never ends well. Professional traders don't try to guess the top. They do something very, very smart. They monitor the signals that indicate when the narrative begins to break. Because when that happens, the move is pretty fast. And that's exactly why here on the Zero Markets channel, we analyze the market beyond the charts, connecting price, macroeconomics, and institutional behavior. If you want to understand the market this way, with a more strategic and less superficial perspective, subscribe to the channel. Because in the next videos, we're going to analyze the macro indicators that institutional traders usually track before major market moves.